I want to very briefly discuss the stochastic RSI. You could also lump the standard RSI into everything basically that I'm about to say. First thing, this is massively pushed. Whether it's crypto, futures, stocks, options, it doesn't matter. It seems like the stochastic and the RSI are hugely pushed by influencers as kind of a cheat sheet to exits and entries into a position. First, if you don't know the math behind how they work, whether it's the standard or the stochastic, I wouldn't recommend using it. And I think that goes for any indicator. You should not use an indicator based on just visuals. Like, yes, that's the idea, that it's an easy visual way to identify patterns in the market or ideas or concepts, which is all just data. But at the same time, I think it's bad practice and bad habits to just put these indicators on your chart and just function based off of them when you have no background understanding of why you're functioning based off of them. Why are you trusting it? For what reason? Could you explain it to me? Probably not. And it's nothing against anybody, because I was that person for a very long time. I used both the RSI and the stochastic massively for years, trading crypto futures, and it was helpful to some degree. I'll say that, like most indicators on higher time frames, the higher you go, it seems like the more reliable they are, because there's much more aggregated data. When you're a day trader, like all of us on the futures funded end of things, I find most indicators to be almost hurtful in most cases. I want to show why this is one of those cases. The stochastic strategy is when you get pinned to this lower band, you exceed the lower band, that's a buy. And if you exceed the upper band, that's a sell. It's pushed at all of you like it's that easy. It's that simple. Well, go back test it. I promise you it's not. It doesn't work. Every once in a while, just like anything, just like flipping a coin, it will work. That long term will wreck you. And I'll show you. This is crude oil. We're looking at the end of October. Here, the RSI is pinned. That, per the stochastic RSI strategy, is a buy. What would have happened if you bought right there? You would have gone sideways with literally no upward motion at all. So really no way to get out. And then it plummets. Okay, what happens down here? You get this little movement and then a drop lower in the RSI. That's a wrecked trade. That's a trade you should not have taken. Let's say you bought at the lower end of this pin, which would be right here. You bought there. You came up a bit. RSI comes up a bit. Price action dunks pretty good, to the point that if you were long with a stop below, you would have got tagged on that stop. You would have been removed from the market. If you were then to ride this through all the way, say this didn't stop you because your stop loss was real low for whatever reason. Well, the RSI would have had you sold right here. That's a very small move. In fact, from where you got in, which would be right here, it's an extremely small move. Now, if you're scalping, sure, it could work. It could work. Is it in any way the best way to go about it? No. I mean, in my opinion, no, it's not. It's a terrible way of going about it. It seems counterproductive, almost. Another good example, RSI's pinned, price action took a little bit of a move down. So should we get in? Well, if you would have here, you did get an up move. You did. However, the RSI is not showing full strength. So many traders would stay in. Price then comes down again. RSI almost resets. And then we get another move up on the RSI. Boom. Well, now you're getting close to the end of the day. The RSI begins to show weakness. And then you just hit this lull, right? After 5 p.m. and the market opens back up again. You get a lull. So would that have been a great trade? No. But if you would have got in right at the bottom and you would have sold when you started to see some kind of weakness, or perhaps when it started to roll over here, it's still a decent trade. You know, you would have gotten right there and you would have got out somewhere right here if you waited for the rollover. If you are perfect, which nobody is, you know, you would have got out on some wicks up here. So does it work? Sure, that would have worked. Let's look here. RSI is pinned to the bottom. Price action comes down a little bit. That's a buy, because the assumption is that you're going to get a big move up in the RSI. Well, is that what happened? No. Price action keeps coming down. RSI stays low as hell. And then that's where you get into this second buy option, right? Where you already got wrecked because you took a long here and price action went down hard. This is your second buy option though, right? So you would have got stopped out here. Now we're going to buy in right here. RSI is pinned, price action right there. Boom, long, we're going up. Okay, RSI begins to come up, but what happens? Boom, stop hit. No good. No good. And even if you would have sustained this, because you had to stop extremely low, which I don't know why you would have it that low, but let's say you did. The RSI comes up, price action comes up, and then you get absolutely wrecked. Bad trade. Bad trade. Let's continue looking at them. RSI is pinned. Okay, that means a sell. So you would have sold right here, hoping to go down. Well, what happens? The RSI stays pinned and price action sweeps up real high. Any stops along this whole way up would have been hit. You would have been blasted. You would have gotten wrecked. So is that a good way of going about trading, even on something like the 5 minute? No. It's per back testing, and in my experience, even forward testing, it's just not a good way of going about trading. If, on the other hand, you're looking at something like CVD, delta, volume, participation, price action itself, and then you also take a quick look at an RSI or the stochastic RSI, and it also seems to be adhering to what you already want to do. Meaning, you've already completely decided that what you're looking at is a good trade. It fits your risk, it fits your plan, it fits your strategy. Cool. And you're like, okay, I want one more confirmation. Pull up the RSI and say you were looking for a short. Everything about the short looked absolutely beautiful. And you happen to have a pinned RSI. It's just another added confirmation. But again, to be super clear, on a trade that you were going to take anyways. I want that to be abundantly clear. Already ready to take the trade. Then, if the stochastic or the RSI aligns with what you were going to do anyways, it's just another feel-good confirmation that the market seems to be ready to go where I think it is going to go. In my opinion, that's all it should be used for. It's just not reliable. It gives a lot of false indications per the way that you're taught to use it. It's just not adequate, in my opinion. If you disagree, let me know. I don't know how you could, though. I don't know how you could. Be careful. Focus on price action. Focus on things like volume and delta, CVD, in my opinion, totally just my opinion. In my experience, they have been much more reliable, have made me feel more confident because they seem to work more often. They seem to be better data points. I guess is how I should say that. The stochastic and the RSI are good data points. Things like CVD, open interest, and price action, in my opinion, are better data points. So then if you have the RSIs as confirmation, like I said, cool. But on their own, standalone, as buy and sell signals, I think they're terrible, terrible ideas. And I don't know why they're pushed so heavily at all of us retail traders. It's just to get you wrecked. Here's another good example. Price action comes down. Per the RSI strategy, that's a long. That's you thinking the price is going to do that. Well, what happens? The RSI flat, price action plummets. You would have been absolutely wrecked. It just doesn't work. It's a good added confirmation. It is not a trading strategy. Good luck. Be safe out there.